All righty. Good morning, everybody. Hope you're doing well. Beautiful Saturday morning. Rick says next week is big on earnings. Yeah, we have some earnings coming next week, and we'll talk about a few of those. So let's jump in. So looking back, if we look at last week, what do we find if we look at last week, just for a little bit of perspective? Monday of last week, SPX was 2677, up 21 points, and VIX was 16.5. And so the early part of the week, we went up a little bit, and then we started a very early part of the week, Monday, right? Tuesday was the big down, was another big up day, and VIX came lower to the 15 level, and we'll talk about what these VIX levels and SPX levels mean in a minute. Wednesday, April 18th, SPX kind of stayed the same. VIX came up a little bit. April 19th, and part of why VIX went up a little bit on Wednesday, just even though the market went up a couple points, was because we're in the lower end of the range in this last 2.5 months as we've had this correction environment. That's what we've been in, and I'll talk about that in a second. Thursday, we went down 15, and Friday we went down 23, as we basically, went up near after Monday and Tuesday basically was the culmination of a 2 or 3 week rally, went up towards 2,700 from the 2,600 levels, and then Wednesday, Thursday, and Friday basically said, hey, we're not going to blow through that 2,700, 2,710, work our way back up to the 2,800 and erase the correction. It's a little early. We're going back down a little bit. So going a step further, here's the bigger perspective. SPX is around 2668 at the close yesterday. It might be within a few points of this. But what kind of market environment have we been in since Feb 1, right, which is, what are we, like 2.5 months, a little more than that? We've been in this correction environment. That's what we've been in, right? But that's the reality, right? You can't say, well, we're in this choppy seas, as John says, but I'm going to trade it according to August of 2017, when we were in the midst of basically from February to middle of September 2017, we were in a 150-point range in the SPX, and VIX was 9 to 11, maybe a little bit of 12. So, you couldn't lose money if you tried to with income trades. You'd have to really work at it. But again, this is the reality. We're still in a correction environment, in my opinion, and it's characterized by SPX about 2,600 to 2,800 and VIX 15 to 25. Have we dipped a little bit under SPX 2,600 level and tested the 200-day moving average, whatever that is, 2580, 2590, somewhere around there? We have. But this has been the basic range. And, a couple of weeks ago, we tested that 2,600 level, went a little bit under that. In the last week or so, we've kind of came back, week and a half, towards the 27, 2010 level. Are we going to erase the correction environment and head to 2,800? No. And VIX has been 15 to 25. So this is the cards that we're dealt with, and this is what we're trading in, right? And based on this, right, this is it. We are not, as much as you dream and try and dream and say, we're in an upward trending market like the last 2-3 years and the vol going down. And you can say it over and over again like Dorothy from Wizard of Oz, but it's not going to happen, right? We're in this range, and you deal with it. When we're not in this environment anymore, right, if we, what's going to take us out of this environment? Number one, on the upside, we start making more of a push towards 27, 2800, stay there a couple months, get the VIX to, 9 to 12, and that would be kind of maybe an end to the correction environment. Or the other way, we blow through 2600 on the downside, and we have a new range, maybe 2600 to 2400. VIX will be a little bit higher, not dramatically, we'll be in a little more bearish environment. But right now, this is where we're at, and we trade accordingly, right? And there's pluses and minuses to it, but it's just getting used to it. It's getting used to driving in snow in Chicago. And everything's in perspective. We'll get to strategies in a second. Mohammed says monthly SPX iron condors are doing great, but not that comfortable with 7 to 16-day iron condors as the market moves big on a daily basis. Yeah, 7 to 16-day iron condors have been doing great, right? And longer-term iron condors have been doing well too. It's just, it depends on things, right? I mean, when 3 weeks ago, or we were doing a little within this 2,800 range. In this period here, we were coming down from the 2,750 to 2,600. That was a little more uncomfortable for any kind of iron condor. But overall, the short-term stuff in the last 2 weeks has been wonderful. All right, my stomach has been quivering. It's been nice. But again, it's all perspective, right? It's all perspective. How are you trading them and how are you managing them, right? We could all talk about short-term trades, but, it's how you trade them, right? That's what it is. All right. So now that we move a little bit from what's going on in the market, I just want to give a quick how I look at things, right? Because sometimes we look at things and say, we're all doing the same thing, right? Iron condors, and we're doing this, but we're not, right? I think, and I want to just be clear, there's a lot of people in here from different walks of life, different, maybe how they've learned options or how they're thinking about options. And this is just what I call the Sheridan methodology. It's not just me and our community, how we look at options, right? And a lot of, how I look at options. And again, just to be clear, I didn't come up with this from, living in a cave in Ireland and I had a vision or something. No, this is just from, trading for a long time, being around and understanding options and what I think, and what I've seen over 15, 16 years of mentoring, what kind of works and what doesn't. And the Sheridan methodology, I'll start off, I don't mean to offend anybody, but I think this first point is the number one point in the world why I think 90% of option traders lose money. Their foundation, they're building houses on water. You're building houses on sand. And I say this to most students, keep your opinion to yourself. Now, let me explain that. Doesn't mean I don't have an opinion. It doesn't mean that I don't watch the ranges of SPX and our students don't and look at technicals and all that. But if you're trying to build a business, if you're trying to make consistent income, and the basis of the consistent income is your opinion on which way the market's going this week or over the next month, I don't want anything to do with it, right? If that's the foundation, and if you look at any brokerage firm, right? Look at the webinars at most brokerage firms. Look at most educators out there. What do they start with? Where do you think the market's going? Where do you think? It's nonsense over the long. That's just my opinion. It's total nonsense, right? Yeah, the market's been bullish for 3 years. Which I'll talk about in a second. In the long portfolio, where it's more neutral to bullish, like covered rights. Yeah, you can take a bullish stance over a long period of time and lean a little bit long. But I'm talking about, I really think this first point gooses most people, right? I don't want anything to do with a business where it's based on your ability to pick direction. Give me a break, right? especially over a month by month, right? Now, if you say, hey, I like Apple over the next year or two, and you're going to do, and that's your neutral to bullish part of your portfolio, and you're going to do covered rights or something, okay, all right? I mean, that makes some sense. All right, probabilities and time decay, that's what we base the strategies on, and that's why you do a lot. All the strategies we do are positive theta, meaning the options we're selling are going to decay more quicker than the ones we're buying. So the strategy is going to be based on decay and probabilities. It's really based on probabilities. Even a calendar at the money is based on probabilities because the way we manage it, right? In other words, when you do a calendar at the money, should you have probabilities in your favor? No, you're doing stinking at the money. Well, how do you get the probabilities? You get the probabilities in your favor by not staying in the trade till expiration, right? Because the longer you're in a trade, the bigger the expected move. The shorter you're in a trade, like with calendars, the less probabilities you're going to go through the break-evens, which are the kind of where you can get hurt. But just for the sake of discussion, probabilities and decay. The other thing is same vehicle, and this is all the jack of all trades, master of none, all right? We trade SPX, we trade RUT. Now, again, if you trade SPX and RUT, does that mean you could trade SPY and IWM? Yeah. And then you could add a few other vehicles to that, liquid stocks, an Apple, Netflix, whatever. Can it be can you have another product like gold or crude oil or whatever? Yeah. But you're trading a few products and you really get to know them, right? To me, it doesn't make sense to put on 40 positions, right? Unless you're a sponsor, unless Red Bull is sponsoring you, right? Right? And they're supplying you with Red Bull all day long. Can you really put on 50 positions? And here's the other thing. If we're talking about SPX, SPX is an index of 500 stocks. Russell's an index of 2,000, right? I want liquid, big indexes. Would you rather trade 10 trades and 10 stocks in the S&P, or would you rather trade one trade in the S&P, right? All right, so that's my thought. Same strategy every week. Again, how do you become a craftsman? Dan, I become a craftsman by putting on a different trade every week. Wrong answer. Wrong answer. You become a craftsman by putting, people put on the same trade, whether it be a covered right or a butterfly, every week until you're 92, right? And you get good at it. This is probably one of the more important things other than you have to trade every week, right? Because the problem with most traders is, especially with the way the internet is, can you find a reason not to get into a trade every week? With all the news and the Twitters and so you have to have a plan. What I'm saying is, folks, it has to be intentional, right? You're not going to make $1,000 a month or $10,000 a month or $500 a month or whatever the number you're going for if you don't have an intentional plan. It's not just going to pop up and you can tell your wife or your husband, wow, I'm consistently getting $1,000 a month. No. Keep your losers near your winners. This is risk management. But again, this to me is the most important point in our methodology or any successful plan. But the beautiful thing about that is, that phrase has nothing to do with even if you claim, Dan, I'm a beginner, I can barely spell the word options, you can understand this, right? This is clear English. You agree? Keep your I'm sorry, I spelled it wrong. Keep your losers near your winners. What does that mean in English and Spanish and Swahili? If I'm trying to make $500 a trade or a week on a trade, when I lose, I can't lose that much more than 500, right? That's English, right? You don't have to understand gamma and theta and standard deviation and expected return to understand what I just said, right? And that's so important. tweak the Greeks and strategies as the market or volatility changes? Can you basically trade a butterfly or an iron condor or a calendar all the time? You can, but you have to tweak the Greeks and so based on the price levels of the market, the speed of the market, and volatility, those three criteria. And then you become a craftsman on 3 to 4 strategies, so it's like 3 or 4 profit centers to get to your intended number per month you're trying to get, and it's a lot of practice. So I just wanted to be clear from the beginning, that's how I look at things. I don't look at things as, for the most part, we start with a plan. We're trying to make X amount per month, and then you build on these strategies, and and that's why we have new students for 6-7 months trade very small, because you got to do this. You got to do a strategy 30, 35 times before you have a stinking clue, right? And people aren't willing to do that. So anyways, I just want to start from the beginning how I look at things, which may be totally different than you. Strategy perspective with SPX at about 26.68 and VIX at 17, that's where we're at today. Agree? That's kind of where we're at. And these are how I break it down in the 3 parts of the portfolio. Just a quick review. The long portfolio, and we might take, as far as if we're allocating, whether it be a $10,000 portfolio, a $100,000 portfolio, or a $1 million portfolio, depending on your experience level, 3 parts of the portfolio, and I would allocate accordingly to the different portfolios based on your interests, but based on what's going on in the market, right? So long portfolio, these are simply strategies that are more neutral to bullish, right? That's it. You're taking a long-term view over a year on a stock. I'm bullish on Apple for a year, or Netflix, or the market, and you're trading. These are strategies that have little or no risk on the upside, much bigger risk on the downside. Do you get that? Little or no risk on the upside, lots of risk on the downside. And these are strategies that for the most of the last 3-4 years, with the exception of the last couple months, right, they've made a lot of you feel like, I've got it, because the market's just been going up. But this is one part of the portfolio, and that's fine. But I believe there needs to be other parts. So long portfolio would be your covered right, no risk on the upside, cash secured put, no risk on the upside, long diagonal, basically no risk on the upside, put credit spread, no risk on the upside, and then I'll put this in there. I think I'll have an example of one of these today. Out of the money put broken wing butterfly, right, which is something that usually has, does it have risk on the upside? Yes, but when you start getting something that has 4 to 5 times less risk on the upside than the downside, I put it in this category. But now the income portfolio are strategies that generally could be higher yield than these strategies generally, but they're going to have some risk on both sides, and generally, you're going to be a little more balanced, right? A little more delta neutral. Iron condors, butterflies. These would be butterflies that would have risk on both sides. They wouldn't be as bullish as something like this. Calendars, double diagonals. And then your speculative portfolio, I put it back spreads, long options, long calls and puts, long verticals, call and put debit spreads, stuff around earnings, long straddles and strangles. So you have this, from the top, you have an intentional plan. You have different allocations. You know what you're going to trade every week. You know the contracts you're going to trade. And then based on 3 criteria, the price levels of, let's say, SPX, the VIX levels, and the speed of the market, you're kind of going to tweak the strategies a little bit in terms of how you may trade them. So there's a little bit of perspective. I just wrote this, April 20th, 2018, stocks well off their highs. We're going to look at a few, just start with a little bit of a stock discussion, and then move into some of the index strategies. But you can see this was yesterday. The ones in the black are the ones that are decently off, relatively, right? Their highs a bit lately. So Apple was around 165-ish level yesterday. March 13th, of a little over a month ago, was at 183. So that's down about, over 10%, with earnings coming up in the next week. Tesla, 291, down 8. I don't know where it finished, but it's around this level. Feb 27th, a couple months ago, was at 360. Google was about 1,077, around that area yesterday, down 12. It was as high as 1,198 on January 29th. So it's 2.5 months ago. So you're talking over 10% also. Facebook, that's hit a lot of interesting news lately. It was around 166 left yesterday. Feb 1, so 2.5 months ago, was 195, right? So that's come down, what's that, 25% or something like that, a decent amount. And that has earnings coming up, right? And then IBM is around 144. January 18th, a couple months ago, was at 171. So that's over, 15%. Yeah, there was a saying at IBM, well, this is years and years and years and years and years ago, sell the 280 calls. IBM must have been trading much higher. And you just sell an out-of-the-money call and it'll expire worthless. And sell enough of them and you can buy a Mercedes. Yeah, funny saying it was. So let's go a couple more. So I'm going to just talk for a second on stocks. I'll just go back and forth there. So earnings next week. And I just took the hot ones, right? I didn't go all of them, just some of the ones that trade the most options. So Apple, and I didn't put the day, I just look at the options where the volatilities are elevated, and it tells me the week. So I don't know which day next week, but Apple's going to be next week, right? What's the day? Is it Monday or Tuesday? But it's going to be next week, April 30th, May 4th. So earnings next week will be Apple, Tesla. Oh, I'm sorry. Did I do this right? What's the date today? I said this wrong. The date today is the 24th. I'm getting ahead of myself. All right. Apple and Tesla are going to be in 2 weeks. Next week will be Amazon, right? April 20, it will be between Monday and Friday of next week. I'm sure they already have when earnings are coming out. So Amazon is next week. Facebook is next week, and Google is next week. Agree? So those are the three big ones that are next week. At least, I mean, there's other ones, but these are the ones I kind of look at. So we have Amazon, Facebook, and Google. And then the week after, next week, then you'll get your Netflix, you'll get your Apple, and you get your Tesla. So next week, Amazon, Facebook, and Google. Those are some big ones. Agree? But again, even though earnings have driven a lot of the market over the last year or whatever, it's sure not driving it the last week or two. Agree? Leanna says they priced the straddle at $55 in Google. Yeah, and it's basically saying, based on Google's movement in the past, a move of $55 up or down is pretty normal. So anyways, that's the earnings. Now, let's just talk a little bit about stocks, and then we'll get into some other strategies. So first, let's put perspective. This would be in the long portfolio part of a strategy, long portfolio part of your options portfolio. And so when I'm choosing something from this part of the portfolio, it would be your cash secured put, covered right, long diagonal, out of the money put, broken wing butterfly, put credit spread, blah, 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 blah. Rick says there's 43 candidates next week. Correct. Good. Thank you, Rick. I'm just focusing on some of the big ones that everybody's looking at. Yeah, there's definitely more than what I mentioned. And again, same concept of, to me, I'm trading a butterfly in SPX. I'm trading a butterfly every week until I'm 92. My advice on earnings is take 4 or 5 stocks that you like to look at and follow those every earnings. I think it's dangerous just to go through a list and, hey, just pick different ones each time. It's an invitation to walk on a landmine. All right, so here's an example just to walk through the process. If we can look at a cash secured put in Apple. Now let's start with the foundation of this. Who should look at a cash secured put in Apple every month, or a covered right in Apple where you're selling some options every month against your long stock? Here's the answer. Someone who likes Apple over the next year. If you don't like Apple over the next year, or Facebook or whatever, would you embark on a strategy every week or every month where you're putting on a neutral to bullish strategy? The answer is no, right? So let's talk about a couple different ways how I might structure a trade in Apple. But again, it's based on the premise, would I do a trade in Apple with earnings coming up because the volatilities are high? No, they're high for a reason. I would do it because I think Apple's neutral to bullish, and if it did go down and I'm selling a put, I'd be thrilled to buy the stock at the strike price less the premium of 153, right? And that's so the example here I'm doing is I'm selling one May 11, 21 days out, 155 put for $2. It's got a delta of 21, so it means that there's only a 21% chance that we're going to finish below the 155 strike by May 11th. Now, earnings are coming. Anything can happen, but it's basically a cash secured put is something you do for monthly or weekly income on a stock that you like over time, and then you're creating a mechanism that you can buy the stock 5 to 10% lower than the current price. So if this is the current price, 165.84, the green is the expiration graph, the purple is the T+0 or the graph for today. And if I'm selling one May 11, as of yesterday's close, 155 put at $2 with the stock at 165.84, I'm basically, as long as we don't finish under 155, I collect the $2 of premium, and it gives me the right to buy the stock at 155 minus 2 is 153, with the stock at 160, almost 166. So I'm basically selling a put that I get monthly income, but it gives me a mechanism to buy the stock 13 points lower than the current price, which is about almost 8% lower than the current price, right? So I have a mechanism to buy the stock 8% lower than the current price on a stock I like. Seems like a no-brainer, but I get monthly income on it. So that's kind of the picture. Now, with that being said, would I do this type of strategy? As they say in Chicago, no way, Jose. Dan, why wouldn't you do this strategy? It kind of looks good. It looks like good probabilities because, again, everything has to be measured by what's my potential yield? What can I make? And when you go, especially if any of you have retirement accounts that you trade options in? Do any of you have retirement accounts that you trade options in? Yeah. So in a retirement account, if you did this strategy, right? If you did this strategy in your retirement account, even if you had the money, and I was the police chief of your town, I'd put you in jail for two nights and let you think about it. I'd put you in jail for 2 nights, and I'd let you really, really think about it, right? I'm joking here, right? I'm not a mayor of any town. I'm not a police chief, but that's what I would do because it's an inefficient use of capital, right? Right? I think it's stupid, right? Excuse the word. That's not, for giving a financial seminar, I'm supposed to use real nice words, right? I'll talk like a financial guy, but I'm not, right? I don't know it. I think it's stupid, right? Dan, why do you think it's stupid? It's an inefficient use of capital, especially, so I'm going to show you how I would do it, right? So if I sold one put, a May 11th, 155 put at $2, what would that cost in a retirement account? It says here, now I don't know if this would be the exact number, at a TD Ameritrade Thinkorswim, it costs about $15,000. Does that seem about right? Yeah, so $15,000. So to make $2, I got to put up $15,000, right? No, I'm not saying it's horrible. I mean, 200 divided by 15,500. All right, it's 1%, but still, it just seems nonsense. So what would I do if I'm selling a put for $2? Right now, they didn't have a lot of. I would buy a put. So this is the same put I'm selling for $2, but I'd buy a put. Generally, my guideline is buy a put at 15% of the value of that. So if I'm selling a put and bringing in $200, 200 times 15% or 20%, go buy a put for 30, 40 cents against it, right? Just by doing that, $30 or $40 will reduce your capital from 15 or 16,000 to 1,200. Let me say it in English, Spanish, and a little Switzerlandish, right? Would you pay on a cash secured put in your retirement account if someone said you could sell a put for $2 and it's going to cost you 15, 16,000, but then somebody else came and said, look it, if you go buy a put against it way out of the money for 30 or 40 bucks, right? 30 or $40, your capital requirement will come down from 15, 16,000 to 1,200. Let's say that again in Spanish, right? Would you pay $30 to reduce your capital by $15,000? Again, if you say no, you're going to jail for 2 nights. You get it? Right? So what do we have here? A wide put credit spread. Right? Now, so I'm going to address what Rick said in a second. I have some very big cautions against that, but we'll get into that. So again, I'm selling the same put I sold before, the 155 put for 2, but I'm buying a May 1, May 11, 143 put. I wanted to buy a put a little more out of the money. They didn't have one. So I was stuck with this, but the whole credit, I'm getting $1.45, right? Instead of getting $2 for the put, I'm getting $1.45. I think this put was 55 cents. I wanted to buy something 35 or 40 cents, but they didn't have it, but this is fine. So now I'm doing a 12 wide put credit spread. So my risk is 1,200 minus my credit of $145. So my margin is 1,055. So now my potential yield at expiration is 13.7% versus 1%. Right? So these wide put credit spreads as an alternative to me to covered rights, to cash secured puts, is a no-brainer. Zero-brainer. Right? And it's just getting used to them. So I'm not interested. So I'd just be trading a put credit spread. I'm not really interested in buying stock. Say, Dan, why aren't you interested in buying stock? Because it costs a heck of a lot of money. And the minute I get stock in the game, my yields go way down. So I would just be doing these wide put credit spreads in stocks I like every month until I'm 92 and a half years old, right? At 92 and a half, I stop. All right. So those are things I'd be looking at today, right? Evaluate. Take a piece of paper and a pen today and look at the stocks in your retirement account, the stocks that you like, and see with the market has backed off over the last couple months a bit, okay, can you get some of those at good prices? I mean, if stocks that you were in love with when they were 10 or 15% higher, you want to keep doing that if these are stocks you like long term. The market's going down. It doesn't mean fundamentally these stocks are, if you still fundamentally like these stocks, continue in them. All right, so these were long portfolio stuff. Now, let me just say this. You ready for my next? So I made one outlandish statement. You should be put in jail. There's two things. So if I'm the police chief of the town that you're in, there's two ways you go to jail. Number one way you go to jail is by doing a covered right or cash secured put for the reasons I just went over. There's another reason you go to jail if you do collars. Anybody ever do a collar? C-O-L-L-A-R, right? It's the second thing you go to jail for, right? Has anybody ever done a collar? I promise if you say yes, I won't put you in jail. If you say that you've done a collar, I promise I won't put you in jail. So go ahead, say it. What is a collar? A collar is you long 100 shares of stock, buy an out-of-the-money put, and sell an out-of-the-money call. They recommend them on CNBC. Okay, then you need to get me, Leanna, a list of everybody who's recommending them on CNBC, and I need to find out the town they're in, and I need to talk to the chief of police and put them in jail. Okay, so get me that information, right? So why would I put you in jail if you're doing a collar? Well, first let's talk, we got to go backwards. What the heck is a collar? A collar is buying an out-of-the-money put and selling a call, right? So Leanna says Dan Nathan should go in jail, right? Right? Get me his information, what town he's from, and we will put him in jail because let's talk about it. All right? And I'm joking. I mean, is there a reason maybe someone would do a collar? There might be. I just don't agree with it, right? I think it's nonsense. So here's the thinking. Would you agree that most people do collar, they start out with, okay, I'm long a stock I like, right? And I sell an out-of-the-money call. So it doesn't go up too fast. I get to collect the money on the income. And then, hey, you know what? Maybe the stocks run up a bit. I'll buy a put against it, right? Is that a little bit of the history of kind of how a collar develops? You don't normally go in and establish a collar, right? So the bottom line is a lot of people will talk about a collar as maybe getting some downside protection on stocks they like, right? And maybe Kevin says some people use them to protect the stock through earnings. But to me, if you ever look at somebody with a collar on, right? Now, yes, maybe through earnings you want to protect yourself. But the problem is that put going to be very, 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 very expensive that you buy to protect it? Yes or no? If you're buying that put and turning it into your position into a collar for earnings, you're paying through your nose and your eyelids. All right, so here's my thought, just for perspective. When you have a collar on, generally, how much do you need let me ask you a question. When you do a collar, Generally, is it protecting you for a 3% move down or a 4%? No. Generally, if you look at a collar, because of the cost of the put and everything, it's only benefiting you if the stock goes down over 10 to 15%. Do you agree? That first 5, 6, 7%, it's not benefiting you. Let me say that again in Spanish. If you have a collar on, I encourage you to look at the graph and say at expiration on that collar, on the downside, does it cover you for a 3% loss in the stock? Does it cover you for if the stock goes down 4% over that period of time? Does it cover you if the stock goes down 6%? Does it cover you if the stock goes down 7%? Right? Not at all. Right? It's generally that bigger move. So then my next thought is, wait a second. If you think a stock could drop 10 or 15%, what do you think is my next question? If you're in a stock that you think can drop 10 or 15%, what do you think my next question is going to be before I give you my solution here? If you're in a stock, why the heck are you owning it? Right? Aren't you supposed to be in covered rights and cash secured puts and these collars on stock you own? So if I think something I own, right? If I have a house and I think the value of the house could drop 15%, wouldn't it make sense maybe to sell it? Right? But here's the other thing. Let's take the current environment. Do I think there's something much better on stocks we like than a collar? Yeah, just do a simple, instead of selling an out of the money call on your covered rights, go in the money. So let's take a look at it. Volatilities are high now. Premiums are higher. So look at this example of Apple. Apple at about $165. Now, am I being dramatic when collars are useless? But, what I'm basically saying is I think there's better ways and more cost efficient to do things, right? So I want to be clear. Here's an example of a covered right. And again, I would never do it like this. I would buy an in-the-money option instead of stock. But here's an example just to make my point. Stock's at 165.77. I'm selling one May 11, 155 call, 10 points in the money. And I'm paying a 153 debit for it. Now, there was 2 or 3 points of premium still in an option, 10 points in the money. But if you look at my break even, I'm just looking here. I should have written it down, but I didn't. But your expiration break even, right? What does that mean, the expiration break even? Where your profit line crosses 0 in 21 days, this is a May 11th expiration. So if my break even is going to be the short strike 155, less than $2 a premium, about 153, right? So I have protection here, almost $13. Apple's almost 166, so 13 divided by 165.77, I've got 8% protection in a stock I like that's already down a lot. Agree? Let me say that again in a little bit of Swahili. Now, Shiv said, is a covered right versus iron condor, which is better? Right? Excuse my bad question back to you, but here's what I'm going to say, Shiv. Who's better, a tennis player or a basketball player? Who's better, a tennis player or a basketball player? Is that a puzzling? Well, why do you think? Well, Dino says a basketball player because he likes. But what's the point? You're asking what's better, a covered right versus an iron condor. That's a tough question. They're not the same. They're two different. Remember my long portfolio strategies? The long portfolio strategies are neutral to bullish. What are they? A covered right, a cash secured put, a long diagonal, an out of the money put broken. So those are all strategies that are very similar. They all have lots of risk on the downside. They have little or no risk on the upside. So if you talk about, hey, is it better a covered right versus a cash secured put, or a covered right versus a long diagonal, or a covered right versus an out of the money put broken wing butterfly, then you could compare them. They're similar. It's like comparing poodles versus poodles. But to compare a covered right versus an iron condor, you have a neutral to bullish strategy versus a strategy that covers more. I'll say this. The only thing I'll say on that is a covered right, if the market is neutral to bullish, right, you'll do better. If the market, but an iron condor is something with good risk management. You can make money down, up, neutral markets depending on how you manage it. So it's more, there's not one better, they're different, right? Anyways, so as we go here, because the big issue is this, Apple's already dropped quite a bit. And I'm doing a 21-day trade that gives me another 8% downside. If I think Apple's going to drop 15 or 20%, I need to go have a turkey sandwich and a lemonade and think about what the heck I'm doing. I need to get out of this and buy a put, or buy a put. You know, what am I doing here, right? Yes, whoever said I'm just trying to keep up with the questions, but covered rights, cash secured puts, are basically the same strategy. Some people may be used to doing one or the other. So anyways, because volatilities are very high, or relatively high now, if I'm looking for downside protection, in the money covered rights to me are much more reasonable than a collar. 100 times better. Now you say, well, Dan, I think the stock's going to drop 30%. Well, then you're going to jail if you're going to keep. Why are you in a bullish position? You know, get out, right? But you know, okay, if I had to make an argument for a collar, it would be, okay, I'm in Apple. I think it's going to drop 20%, and then when it goes down 20%, I'm going to sell out my put. You know, that's a crazy game, right? I'm going to pay up on volatility to buy a put. I'm going to guess it's going to go down 20%. I'm probably going to be wrong. All right. Anyways, so those are my thinking. Next. So now let's move into a few other strategies. Let me see what time it is. I don't want to go later than 11. I only like to go about an hour, but maybe I'll go a little later. I'll cut this off at 11:15, and if what I don't cover, I'll do it. I think I'll do another one in a couple of weeks on a Saturday. But the idea with covered rights, I'll just explain this, is it's all about the downside. Right now, volatilities are higher. So I think you're getting more premium on the covered rights, but it's all about downside protection. And with the volatilities higher, if I'm concerned about the downside on a stock I like, just because maybe we're going to test the 2,600 level and the market's going to bring some of these stocks down, you know, I think these in-the-money covered rights are a nice opportunity right now to give you more downside. But again, to get a collar on, you're looking for a much bigger downside. Why are you in the stock? You know, unless it was given to you by your grandmother and you don't want to get out, you know, unless there's some crazy reason like that. But from a capital reason and in a yield reason, I don't see it. Any trade idea for Google before Monday, end of day earnings? I don't have any trade idea right now. I could look at it maybe at the end of class. Maybe remind me at the end if we have a few minutes. I'll take a look at Google. Yeah, Dino was talking about what's a covered right for the SPX would be, you know, maybe buying a 3 to 6 month 80 delta option as a surrogate for the underlined, and then selling out of the money or at the money or in the money call. And again, if I'm bullish on a stock or an index, I'm going to sell an out of the money call. If I'm more neutral, but I want some downside protection, selling at the money. If I'm concerned about, hey, for the next 3 weeks or 4 weeks, the market could go down some, then I would sell an in the money call. And right now you're getting a benefit of volatilities aren't 9 or 11 in the VIX, they're much higher. All right, now let's get into the income part of the portfolio. Here's a short-term duration trade, pluses and minuses. So I'm going to talk about a 7 to 14-day trade. And these would be called, some people, what do you guys call 7 to 14-day trades? Do you call them weeklies? What do you call them? In your vernacular, what do you call 7 to 14-day trades? What do you guys call them? Short-term, weeklies? Now, could weeklies be a confusing term? Yeah, but I get what people mean. Weekly, short-term. But, could I go every Wednesday into the brokerage platform and put on a 30-day weekly trade? Could I go every Wednesday and put on a 40-day weekly trade or a 45-day weekly trade? Yeah, so weekly trades can be short expiration trades or they can be long, correct? But if you call them weekly, I get it, but we're talking short duration trades that expire in 7 to 14, 7 to 15 days, right? And you say, what are the pluses of those trades? So if we're talking iron condors, butterflies, covered rights, whatever, what are the pluses of short-term trades? What are the pluses of short-term trades? Why would you do them versus a 30 to 60-day trade? Higher theta, make more yield, but you'd be trading less capital. But if you trade a 7 to 14-day trade, 95% of the time you're going to get it off by the time you put the next trade on the next week. So you're not tying up capital. If you do a 60-day trade, you're not getting out in a week. You're tying up a lot more capital. So the pluses of a short-term trade are much higher yield, less capital. What else? Anything else? Any other big advantages? The other big one is it's not less risk, not necessarily less risk, but I would say less days in a trade. I think that's, so I may put a trade on a Tuesday and get out by Thursday, and then I may not enter again until Tuesday. So less time in a trade. What also is an advantage of a shorter term trade over a longer term trade? Less volatility risk, right? Compared to it. And you have that big theta offsetting it. What's the biggest risk you're concerned with short-term trades? What's the biggest risk you're concerned with short-term trades? Let's go to the other side of the coin. Price risk, that's it. Price, that's it. That's it. Now, some of that is offset by the fact that, for example, this iron condor, I'd call this a 7-day iron condor. So just because I was doing this slide yesterday on a Friday, so let's say you put on an iron condor every Friday. I don't normally put it on Friday. I'd put it on Tuesday or Thursday. But if I put one on every Friday, right? So if I put one on yesterday, like this trade, I'd be off in 2 or 3 days. And then I'm out of the market for a couple days. You see that? So one of the advantages of an iron condor, the short term, is I'm not in them all the time. Versus if we have a big move next Thursday in the SPX and you have a 60-day iron condor on, your boat's going to be in the water, right? Versus if you have a 7-day iron condor and you put it on Friday, you're probably going to be out by Tuesday, right? Maybe Wednesday. So anyways, but price risk is the big risk that you have to be careful with these short terms. And And when things go against you in terms of risk, I'm less tolerant because things can move against you quickly. I'm less tolerant about doing a lot of adjustments with these. So here's an example of a pretty close to delta neutral, within one delta long or short. I'm selling an iron Condor. I'm selling an out of the money call at the 27.30 call. That is a delta of 12. And I'm selling an out of the money put at the 26.10 put. It has a delta of 17. So that's why I'm picking the short strikes. And by doing a larger delta in the puts than calls, it'll give my deltas within one delta. So I want to get close to zero. So on the upside for a 7-day iron Condor, an environment as of yesterday with VIX about 16.5, I've got about 55 points out of the money on the call side and about 64 points out of the money on the downside. Again, this is a 7-day iron Condor. The Greeks are, I have positive 26 theta. I have negative 32 vega. So my theta is almost as big as this, right? Whereas if this were a 30 or 60-day trade, your theta might be 4, right? So the real risk is your price risk. And this is the expiration graph. This is your T+0 graph, and you can see the steepness. These are going to be a little steeper than the T+0 graph of a 40-day trade. The credit is $2.25. The margin is $7.75, which is the difference between the long and the short on the spread. So these are 10 wide credit spreads. So you have $1,000 of risk less your credit for every one contract. So you have $775. When I say 7-day, I mean 7 days. So if I put it on Friday, it'd be Friday expiration, which would be April. So this iron Condor, I took the slide from yesterday. Yesterday was April 20th. The expiration is April 27th. That's 7 days. That is 7 days. Now, on this trade, how is this an iron Condor with the VIX at 16.5 and SPX at 26.74? It's a little different than doing an iron Condor, 7-day iron Condor when VIX was 9 or 11 in December or November or January, December or November of last year, even some of January. You're getting more room farther apart for the same deltas, and you're getting a bigger credit, so you can absorb some bigger moves. But the key is, what's the plan? Generally, on a 7-day iron Condor, I'm looking to be in the trade 2 to 3 days. That's it. So suffice to say, the market can move less than 2 to 3 days than it can on a 60-day trade. So that would be basically the trade. And these have been working pretty well. Over the last, overall, they've been working pretty well over the last 3 months. There's been some bumps. And the key is, I might look to make, let's say, 8% on this for every one. Well, 8% of 775 would be about $60. So when this credit goes from 225 minus 60, I might have an order to buy it back for $1.65 debit after a couple days. Right? So I'm looking to make 8% on your margin. So on one contract, 8% would be about $60. So I'd have an order to buy it back for $1.65 debit. How about the loss? I don't want to lose much more than I'm making. So if I'm looking to make 8%, don't want to lose more than 10%. 10% of 775 times 10% would be about $75. So I'd have $75. So that means once this 225 credit, if that gets 3 or over, I'm out, right? So I don't have time to get into adjustments, but I will, on 7 of 14-day trades, I would allot one adjustment, right? One adjustment, right? And on these short-term trades. Let me just say something for those who might. I'll go another 10 minutes, a couple more of these strategies, but I just want for people who might have to leave early, just to get a couple things going on with us over the next couple months, so you just at least know of them. Hot off the press next week, we just finished, and it just triggered, Philip mentioned these. I just finished a 3-week class. I'm finishing this Tuesday, managing short-term trades in this market. So managing, trading these short-term trades, and we put live trades on during all of them, and they all did well. But again, that doesn't, that's not the point of it. The point is, I'm showing you how to do it. The market was quieter, really, over most of the period that we've been teaching it. But if you're interested in short-term trades, just did a 3-week class. The last class will be Tuesday. We'll probably have it available for sale on Wednesday. And that's information on that. And the last thing, May 31st, June 1st, we're doing our big live event for the year, the Chicago seminar. And these are some of the speakers coming. We have a lot of some Sheridan students are sharing what they've done over the last year. And then we have some outside speakers, Jim Bittman, who used to be with the CBOE. He's going to be speaking on credit spreads, Tom Sosnoff, and Tony Batista of Tasty Trade, Brian Overby over at Ally Invest, previously Trade King, Mark Fenton, a mentor with us, and then a lot of students who are going to share very to the heart what they've been doing, right? Their journey, how they're doing, what they're doing. So I think it'll be a great, but if you want some information on that, it's a beautiful event. The Chicago Gleacher Center. It's a 2-day event. And would encourage you to think about coming to that. And that's the information there. Okay, let's get back to for those who can't make it live, we should have it available online. I'm pretty sure, I'm not positive we should, but this is the type of event, and I don't just say this to get you to come to Chicago. I don't, whether we price this accordingly that, believe it or not, we try to break even on the event. This is a lot for students, and some non-students come, but it's, for a 2-day event with food and drinks and different things, not drinks, alcohol, but, it's in the 400s, which is unheard of for a good 2-day option seminar. But coming will encourage you. Coming and being with people doing it, it's not the same watching it recorded. All right, let's go back to a couple more strategies. Here's an example, again, taking out of the, this would be more the long portfolio, and I'll explain why. A long portfolio generally, and this has worked, like an ATM machine over the last 3 years, along with cash secured puts, covered rights, put credit spreads, and any of the strategies mentioned in the long portfolio part, because the market's gone up, and you got a strategy that has 5 times less risk on the upside than the downside, right? It's conducive to the upside, not the downside. But this would be, we call it an all put flat fly. It's simply Mark Fenton, who gave it that name, who's very good at this strategy. It's just an out of the money put broken wing butterfly, many different versions, but again, much more conducive and easy in an up environment, because you can see there's not much risk on the upside. It's really hard to lose money on the upside. But the structure of this is, if we're at 2673, when I took this, you buy a long put, it's all puts, buy a long put about 20 points up. We're 49 days out, so as of yesterday, this was the June 8th expiration. I'll buy a put about 20 points up, so buy one 26.95 put, sell two 26.55 puts about 40 points down, And that delta is going to be around 41 or 42. Some people will structure it, the short put, maybe a 30 or 31 delta. But the problem is, as you can see here, here's the underlying price. You're already almost outside the profit graph, if this is the profit graph. Whereas if you start this with a delta even lower at the short put, you're basically starting the trade almost outside the profit area. So it's just, I don't think that makes any sense for many reasons. But and then you buy, so you're buying a put 20 points up about from the current price, selling a put about 40 points down, buying a put about 50 points down against it. And this is the rough setup. Again, depending on the market conditions, the volatility, the speed of the market, you may do it a little bit differently. But so it's going for a $2 debit. The risk or margin is about $1,200, right? Anytime this would be called a broken wing, out of the money put, broken wing butterfly. All the options are out of the money. The short put's out of the money. Broken wing being the distance from the highest strike long put to the short put is 40. The distance from the lowest strike long put to the short put is 50. So we call this a 40-50. And you can see here, it's just very conducive to the upside. There's really more finagling on the upside to try to get a profit out of it. But it's very, you can see, very little risk on the upside. So this would be called all put flat fly. So this would be a strategy that out of the long portfolio, do I do a strategy like this? Do I do a put credit spread? Do I do a covered right, cash secured put? That's what this would be kind of competing with. I mean, this is a good strategy right now with VIX up in the 16, 17 level, still relatively high over the last couple of years. It's a decent strategy. And the other thing is, again, would you rather do a neutral to bullish strategy when the market's off 6-7%, or would you rather do it at the highs in the market? You see what I'm saying? So there's some benefit of doing a neutral to bullish strategy after it's been down some and the volatilities are a little higher. Again, I don't have a chance to get into the whole risk management of this trade. Generally, if this is a 49-day trade, you may be in it 3 weeks, possibly 4 weeks, but I'd say about 3. Oh, Dino says about 20 days. Maybe that's about, maybe I was a little too long. So maybe 20 to 25 days on this. All right. Anyways, I think I'll stop it there. I said I want to go through, but at least hopefully get you thinking, hopefully get you working on the craft. Hopefully I've said a few things today that at least get you maybe thinking a little differently maybe than how you look at the options business. And, Leanna says Google. Okay, now first of all, if we're going to look at Google, where do you think that would fit in Leanna's portfolio? So if we're going to look at Google for a strategy around Google earnings, where does that fit in Leanna's portfolio? Is it the quick money, just give me money, or where does it fit in? Would it be, well, like Dino said, it's a spec trade, right? But whether you call it a one-day trade, an earnings trade, it's in the speculative part of the portfolio. What does that mean? This isn't like a butterfly where I'm doing a non-directional butterfly on every week or every month, right? It's a spec trade. So for me, in my spec part of the portfolio, it's competing against buying calls and puts in stocks I think are going to go up or down, or buying put verticals or call verticals, it would be in that allocation of a spec trade. So why is it considered a spec trade? The premiums are high. I could just sell these expensive premiums, because here's the difference between selling options in Google for earnings and selling options in SPX Monday. If SPX moves, right, unless something dramatic happens, as it moves against you, are you able to adjust it when you want? Yes or no? If you have a iron condor or some type of income trade in SPX and it moves against you, are you able to fix it when you want? The answer is yes. If you enter an iron condor or some type of trade in Google, are you able to fix it when you want? Yes or no? Here's the answer. No. No. If you put it on for Google's earnings and you're going to leave it on for Google's earnings, when Google's earnings come out, there's going to be a big gap in the stock generally, and you're not able to do something. You say, what if it's going to gap bigger than I want it to? Can you call up the specialist in New York and say, you know what, I'm going to be losing a lot of money if you open Google down $100. Please don't open it down that much. Do you think you'll be able to make that phone call? No, no. So let's look at Google real quick, and we'll take a look at, again, this is total the spec trade, right? So if you look at a price chart, you know, has Google kind of come off? Google had as much as 1198 on January 29th. What do most of you, and so Google's trading at around 1077. What do you guys, before we look at a strategy, what's your guys' opinion? Are most of you bullish or bearish on Google for earnings? All right, and we're getting exactly what I thought. Bears, and we have some bulls, and we have some bulls, and we have some bears. All right, so let's take a look at this. Now, the expected move, where did I say this at Think or Swim? I mean, to me, the expected move, I just look at the money straddle. So if we look at, so earnings are coming out. Let me just see this here. So if you look here, earnings are coming out. How do you know they're going to be coming out next week? Well, you can look at the at-the-money 1077 strike, and you look at how high the volatility is on options that expire next week. And then you look at the weeks after, right? And the at-the-money 1077, look how the volatility drops. So it's saying the event is going to happen next week, and the volatilities are high. So let's just take a look at this. So this says the expected move. Well, it's like the at-the-money. Let's take a look at this. The at-the-money, we take, you know, the at-the-money calls and puts. If you add them up, it's almost 28 and 28 would be about $56, right? That's at least how I would do it. They're doing it. I'm not sure exactly how Thinkorswim does it. They get a number. Is this their market maker move thing? Am I looking at the right number? They say it's 48. Is that correct? All right. I look at it this way. Well, we're close, but I say 56. But and all the principle behind this is saying if you bought an at-the-money call and put, how far would you need Google to move to break even? Well, if you bought an at-the-money straddle Friday, it cost you about $50 bucks, $50 to $56. You need a 56-point move to break even, right? So if you need about a 50-point move to break even, what you're saying is you need about a 5% move in Google just to break even, right? So Evel Knievel needs a 5% move just to live, right? So if you bought a straddle, right, and Google only moved 0 to 5%, even if Google moved $30, $40, $50, you'd lose money. Why? Because there's such a premium on it, right? There's such a premium. Agree? It's like the real estate market in New York. Is there a premium on buying something in New York or Hong Kong or some of those cities? Yeah. Right? And so If Google doesn't move more than $55, right, this is toast, right? Now, again, I don't, Rick's talking about my trades are symmetrical, but again, whatever you say, doing iron condors and these types of trades around earnings are spec, right? I don't care what you say, right? Because something bad can happen, right? And Google could go down 30%. And you're lying on the ground talking to yourself, ah! Right? So, yes, we can look at an iron condor here, but, so what we're saying, market maker move, again, I don't know how they came up with that term, but I'm just giving you my English of it is you're projecting based on how much people are willing to pay for these options. You're projecting based on real money buying options what a projected move is. So it's really not a market maker move. It's just people that are bidding up options. So why are people paying for a 1075 put? That's $2 out of the money. Why in the world would a sane person with a Social Security number pay $28 for a put that's going to expire in 7 days? That's only $2 out of the money. Why would they pay $28? It's because they have a newspaper that says the last 7 or 8 Google earnings, it can move 5 or 6%. So they're projecting that they're willing to pay for that, right? So if we look at an iron condor, Leanna says the big IV skew should be good for a calendar spread. Or is it too good to be true? It's too good to be true. Why? I'll show you. Let's just look at a calendar since Leanna was the one who said look at Google. But let's look and see. So if we look at a calendar, right, we're going to sell these options that are very bloated, high volatility, and we're going to buy. So let's do a calendar. And what's that show? Myths and Blunders. So let's do that. So here's a calendar trade where in Google, where we're going to sell these bloated options in the April 27 expiration, and then we're going to buy an expiration that expires, let's say May 11th, and those would be much cheaper options, right? And that's what they tell you in the Options 101 book, right? Buy cheap vol, sell expensive. So let's take a look at this and see, will this work? And what does it say, right? Because Leanna says, yeah, you're right. Wow, we're going to sell this really expensive volatility. We're going to buy really cheap. We should be doing really well. So let's take a look at that. So let's say we go at the money and we do this calendar, and you look at this calendar and it looks beautiful. It looks absolutely beautiful. I think Leanna's discovered gold, right? But let's take a look at this. Let's look at this calendar. What are we doing? We're selling one April 27 at the money call. When does April 27 expire? Anybody know? Next Friday. And then we're going to buy one May 11th, and we're just going to do it right at the money, the 1077 and a half. So what is this telling us at expiration? The volatilities are very high. So it's saying, here's what it's saying. It's saying all in this area. If Google closes in this area, Leanna goes to Disney World, right? But at these expiration break-evens, if we go beyond there, we lose money. So 1077 is to strike at the money. And I'm going to talk about this in a second. The expiration break-evens, even though these are aren't accurate. We'll just use these for sake of argument here. 10.10. And on the downside, on the upside, about 11.50. So you've basically got about 60, 70 points or so where you make money, and then beyond that you lose money, right? And the bottom line is this graph accurate? No, because what you're not doing here is when the news comes out, will this graph look like this? No. Why? Volatility will come down, and I don't think or swim. Most of these brokerage firms don't have the correct tools to what you'd have to do here to give you an accurate view of what this will look like the morning after earnings comes out. The volatility of your short options will come down a ton. The volatility of your long options will come down probably half the amount. And if I had a software, something that had where I could lower the volatility, you could do that. It'd be more accurate. But the bottom line is, if we had an accurate piece of software that could lower the volatility of each of them, do you know what you'd find out here, folks? You'd find out here that on the calendar, if it moved anywhere near the expected move, you know what? You wouldn't make any money, right? That's it. So you wouldn't make any, right? So the point is these types of trades, right? Calendar is a little more complicated for earnings than an iron condor, but the bottom line, to look at it like this: when would I put an at-the-money calendar like this, like Leanna said, on, whether it be Google or Apple or whatever the stock? When would I put an at-the-money calendar? What's the answer? What's the answer? When would I put an at-the-money calendar on in Netflix, Apple, or whatever, going through earnings, where I'm going to sell that expiration with the really high volatility, and I'm going to go out a couple of weeks and buy something cheaper? When would I do it? What's the answer? What's the answer? There is an answer. I want you to know there absolutely is an answer. And I think Herb is getting near it. What the answer is what move are they saying? What's the expected move in Google? What's the expected move in Google? Let me say it in Spanish. What is the expected move in Google based on the expected move from Thinkorswim or the at-the-money straddle? What is the expected move? Okay, let's say it's 57 points. What percent move is that? 57 divided by 1,077. So what percent move are they expecting in Google? About a 5% move. So let's finish the sentence. Dan, when would you do an at-the-money calendar in Google like you're talking about for earnings? The answer is, if I expect the move in Google up or down to move 2 to 4%, I would do this trade. If I expect the move in Google or Apple to be less than the expectations, that's the only time I would do that trade, right? So Dan, are you saying you wouldn't do it because the volatility is high relative to the ones you're buying? No, it has nothing to do with it, right? That's all priced in. That's all priced in, right? I would only do it based on that. Anyways, folks, it's been wonderful chatting with you today. Have a nice weekend. We'll see you in a couple weeks. We'll cover some more things. We'll go from there. If you have any other questions, you can email me, Dan@SheridanMentoring.com. Send me an email. I'll be happy to help you. Have a nice day. Thanks.